Bismillahirrahmanirrahim. Assalamu alaikum. Good afternoon, everybody. In this session, we shall cover International Financial Reporting Standard 15, and we shall try to cover many areas of IFRS 15, but may not be 100%. So, but in order to get most benefit out of this session, so have a notebook and pen ready, but do not try to write everything. You can ask question, but all question cannot be answered, but we shall try to answer as many questions as possible. We shall be having frequent question answer breaks, and during those breaks you can ask your questions. Should I repeat? Okay. Contents. We shall be discussing IFRS 15, the difference between IAS 18 and IFRS 15, impact of IFRS 15, and the most impacted industries. This International Financial Reporting Standard 15 will replace the following standards and interpretations. International Accounting Standard 11, Construction Contracts. International Accounting Standard 18, Revenue. Interpretation 13, Customer Loyalty Programs. Interpretation 15, Agreements for the Construction of Real Estate. Interpretation 18, Transfer of Assets from Customers. And Interpretation 31, Revenue, Barter Transactions involving advertising services. Further, IFRS 15 applies to all contracts with customers except leases within the scope of IAS 17 or IFRS 16. Insurance contracts within the scope of IAS 4. Financial instruments and other contractual rights and obligations within the scope of IFRS 9, IFRS 10, IFRS 11, IAS 27, or IAS 28, and non-monetary exchanges between entities in the same line of business. For example, this standard would not apply to a contract between two oil companies that agree to an exchange of oil to fulfill demand from their customers in different specified locations on a timely basis. So this was the scope of the standard. Application. This standard will be applicable for reporting periods beginning on or after 1st January 2018. Early application is permitted. If you want to apply it early or before this date, you can do that. What is the core principle? See, the core principle is an entity shall recognize revenue when or as the entity satisfies a performance obligation by transferring promised goods or services to customers at an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. So this is the core principle. Means satisfaction of performance obligation is very important. So this is the key principle within the standard, which will keep coming back within the standard. Fundamentally, you should forget about matching revenue to cost and potentially forget about strike lining as a default recognition method for some services. So this is the fundamental principle. This is termed as a 5-step model for the recognition of the revenue. 5-step model for the recognition of revenue is, step number 1 is identification of the contract with the customer. Then step number 2, identification of separate performance obligations in the contract. Of course, we will discuss in length all these steps. Step number 3, determine the transaction price. And step number 4, allocation of the transaction price to the separate performance obligation. If there is only one performance obligation, so automatically step number 4 will not apply. Step number 5, revenue to be recognized as each performance obligation is satisfied. So these are the 5 steps. These are the basic steps for the recognition of revenue, and the steps given in ISA 18 are no longer applicable from the date of application of this standard. The companies will have to apply these 5 steps while recognizing the revenue. Okay, let's start with step number 1. Step number 1, identification of the contract with the customer. See, the parties to the contract have approved the contract in writing, orally, or employed by customary business practices and are committed to perform their respective obligations. The entity can identify each party's rights regarding the goods or services to be transferred. The entity can identify the payment terms for the goods or services to be transferred. And the contract has commercial substance. The risk, timing, and amount of the entity's future cash flows is expected to change as a result of the contract. It is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. So all these conditions must be satisfied in order to establish that there is a contract. But in case of normal retail sale, you go to the local grocery store and there is no written contract between customer and the shopkeeper, but there is an oral or employed contract in that transaction. Further, contracts does not exist if both parties can cancel that contract without penalty. For example, this may apply in a situation where an individual may pledge to future donations where the pledge is not enforceable in law, or purchase order can be cancelled without any penalty. So let's try to understand few of its terms with the help of example. You have with you example number 1. A non-refundable deposit of 50,000. Non-refundable deposits of 50,000. So let me activate this pen as well so that I can use it. Okay. The customer pays a non-refundable deposit of 50,000 at inception of the contract and enters into a long-term financing agreement with the entity for the remaining 95% of the promised considerations. The financing arrangement is provided on a non-recourse basis, which means that if the customer defaults, the entities can repossess the building, but cannot seek further compensation from the customer, even if the collateral does not cover the full value of the amount owed. The entity's cost of the building is 600,000. The customer obtains control of the building at contract inception. Now the question arises, should the entity recognize 1 million as a revenue? Okay. In assessing whether the contract meets the criteria, the entity concludes that the criteria is not met because it is not probable that the entity will collect the consideration to which it is entitled in exchange for the transfer of the building. In reaching this conclusion, the entity observes that the customer's ability and intention to pay may be in doubt because of the following factors. The customer intends to pay the loan, which has a significant balance, primarily from income derived from its restaurant business, which is a business facing significant risk because of high competition in industry and the customer's limited experience. The customer lacks other income or assets that could be used to repay the loan, and the customer ability under this loan is limited because the loan is non-recourse. So here it is not probable, the last condition, if we come back to our slides, it is not probable that the entity will be able to collect this money. So that's why, because step number 1 is not fulfilled, step number 1 is Okay, I hope you people can hear me. So here in this example, see, it is not probable that entity will be able to collect remaining 95%. So this entity will not recognize 1 million as a revenue. Next is, we continue with step number 1. See, if consideration has been received, like in case example number 1, we received the consideration, but the contract criteria is not met. But remember, revenue is recognized only when either the entity has remaining obligations and substantially all the consideration has been received and is not refundable, or the contract has been terminated and the consideration received is non-refundable. Here in case of example number 1, entity has a remaining obligation. This means step number 1 is not, this criterion is not fulfilled. And step number 2, contract has not been terminated. So none of the criteria is being met. So in example 1, instead of recognizing 1 million as a revenue, the entity will recognize 50,000 as advance from customer. Further, consider a non-refundable 10% deposit paid for the construction and supply of asset, and the supplier cannot recognize 10% deposit received as revenue if it is assessed that there is only performance obligation, being the delivery for the constructed asset to the customer, because in this case there are remaining obligations required to be completed by the supplier, that is the delivery of constructed asset. So therefore condition 1, this condition 1 is not met. Similarly, if customer credit risk deteriorates as such that supplier believes would not be able to complete the transactions, we still could not recognize the revenue on 10% deposit, because this number 2 has not been met, because the contract has not been terminated. So the deposit will be recorded as a liability until either of the above conditions 1 or 2 is satisfied. Okay, let's see example number 2. Let's see example number 2. We have here example number 2. The entity observes that none of the events described have occurred. That is, the entity has not received substantially. Okay, in example number 2, I have already explained, because this example number 2 is with reference to the example number 1. In example number 1, that 50,000 will be recognized as advance from customer as a liability, and that 1 million will not be recognized as a revenue. So if we have any question related to this step number 1, so I can answer that before moving further.
Najmullah is asking, so please explain about commercial substance in step 1.
Commercial substance in step number 1. See, commercial substance, okay. See, if the risk, timing or amount of the entity's future cash flow is expected to change as a result of the contract. Like if you sell something, of course this will affect your cash flows. So then that contract will have the commercial substance, and you cannot cancel that without penalty. If there is no penalty and you can cancel that contract, even then this transaction will not have any commercial substance. Next.
That's the only question so far.
Okay. Anyway, if anybody has a question related to the step number 1, so it is better that should be asked at this point in time. Step number 1 is identification of the contract with the customer. It could be written, verbal, or employed, and in order to satisfy this criteria, there are certain terms which should be there, certain matters which should be included in that contract. Okay. Then is okay. Can people hear us?
No.
Okay, fine.
Alright, so there's this question from Muhammad Arsalan Abbas saying, what about the 600,000 cost? Should that be recognized in the cost of sales?
No, that will not be recognized in cost of sale. This is only advance from the customer. This 50,000 will be treated as an advance from customer.
Right. Nasser Ali is saying, so in example 1, there is no contract
Yes.
at all.
Yes.
Recognize the revenue.
Why? Because the last criterion is not being met. This probable collection of consideration. Okay, next.
That's it.
Okay, now moves to step number 2. Step number 2 is identification of the separate performance obligations in the contract. How many performance obligations are there? A contract includes promises to transfer goods or services to a customer. These promises are called performance obligations. Why is identifying the performance obligation is important? Because it determines when and to what extent revenue is recognized. So 2 conditions must be satisfied. Number 1, is the good or service capable of being distinct? Is the good or service capable of being distinct? And is the good or service distinct in the context of the contract? See, sometimes this could be the possibility that goods and services are capable of being distinct. But in the context of the contract, they are not distinct. So this means in that case, second criterion will not meet. So as a result, step number 2 is not being satisfied. The contract as a whole will be taken as a single performance obligation. Within one contract, there could be many performance obligations. For example, in case 1, if the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer, so then it will be considered that that good or service is a distinct product, good or service from other goods or services. And in case of 2, if goods or services are highly dependent or highly correlated with or significantly or customizes other promised goods or services in the contract. So we will understand this concept with the help of a couple of examples. ABC Limited, a limited company, has developed a software package. Okay, let us use pen here in order to. Software package. ABC Limited has entered into a contract with XYZ Limited to supply the following. Number one, license to use software. License to use software. License to use software. Number two, installation service. Installation service. But for installation service, remember, this may require an upgrade to the computer operating system, but the software package does not need to be customized. This software package will remain the same, maybe some upgradation to the operating system. Third, technical support for 3 years. देखिए फिर आप सॉन्ग पे चलिए तो बड़ा स्मूथ रहता है. कहाँ से बात नहीं गई, मैं ताकि बात से शुरू करूँ. वही लास्ट में जैसे मुझे कीप. Okay. Sorry for technical interruptions. We were discussing, okay, let me repeat it quickly. We were discussing step number 2. And in step number 2, in order to make you understand this slide, which is in front of you, I started an example. ABC Limited, a limited company, has developed a software package. ABC Limited has entered into a contract with XYZ Limited to supply the following. Number one, license to use software. Number two, installation service. And I mentioned earlier, this installation service will require an upgradation to the computer operating system, but the software package does not need to be customized. Number three, technical support for 3 years. Technical support for 3 years. And number 4, 3 years of updates for software. 3 years of updates for software. So one contract includes these 4 things. ABC Limited is not the only company able to install the software. Mean that software can be installed by any other company. Not working? So should I stop? You can use this port. This port is very dependable. Use new hardware.
Yes.
Okay. Sorry for technical interruption, and continuing from a last example, that contract mentioned that these four things. ABC Limited is not the only company able to install the software, and the technical support organizer has stopped sharing your backgrounds. Okay, on कर लिया. Yes. इसको ओके करके यहाँ से तो वॉइस भी नहीं मेरी जा रही.
वॉइस आ रही है.
अच्छा, नहीं वो कैमरे का नहीं, वो मुझे इशू, लेकिन वॉइस जानी चाहिए. Okay, fine, thank you. Should I continue because my
Yes.
microphone is okay?
It's on.
Okay, fine. ABC Limited is not the only company able to install the software, and the technical support can also be provided by other companies. The software can function without the updates and technical support. So now here we need to decide that this contract contains 4 different performance obligations, or there is only one performance obligation. See, software was delivered before the other goods or services and remains functional without the updates and technical support. This means these are 3 years updates. Software is not dependent on them, and without technical support, software was in a working condition. It may be concluded that XYZ Limited can benefit from each of the goods or services either on their own. XYZ, this company can benefit from license to use the software, installation services, technical support for 3 years, 3 years updates for software on their own or together with other resources that are readily available to the customer. So this means there are 4 distinct performance obligations. There are 4 distinct performance obligations. In particular, installation service does not significantly modify the software itself, and as such the software and the installation service are separate outputs promised by ABC Limited rather than inputs used to produce a combined output. In conclusion, the goods and services are distinct and amount to 4 performance obligations in the contract under IFRS 15. If you people have any question related to this, because I explained it that in terms of number 1. Okay. If you have any question, please type it now, and I continue with my illustration number 2 in order to explain this second step. if we acquire some IT equipment that involves substantial customization, the provision of those services would be distinct as they are input into functioning integrated operating IT system. In other words, the promised goods in this case might be met. In this case, number 1 might be met, but 2 is not met because 2 is not distinct. Therefore, in this example, there would only be one performance obligation. Do we have any question? I suppose we should have any question because I have discussed. Can you people hear us? Please reply us with yes if you can hear us. Okay. So let's see another example. Another example is products and services, goods and services not distinct. In this example, we will see that though products and services are distinct, goods or services are distinct, but they are not distinct in the context of the contract. An entity, a contractor, enters into a contract, Can you check with the people? Goods and services. Okay, an entity, a contractor, enters into a contract to build a hospital for a customer. The entity is responsible for the overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. The promised goods and services are capable of being distinct in accordance with IFRS 15. That is, the customer can benefit from goods and services either on their own or together with other readily available resources. This is evidenced by the fact that the entity or competitors of the entity regularly sells many of these goods and services separately to other customers. In addition, the customer could generate economic benefit from the individual goods and services by using, consuming, selling, or holding those goods or services. However, the goods and services are not distinct within the context of the contract in accordance with IFRS 15. That is, the entities promise to transfer the individual goods and services in the contract are not separately identifiable from other promises in the contract. This is evidenced by the fact that the entity provides a significant service of integrating the goods and services, the inputs into the hospital, the combined output for which the customer has contracted. because both criteria are not met. The goods and services are not distinct. The entity accounts for all the goods and services in the contract as a single performance obligation. See, if I just summarize it, in the construction of this hospital, many goods and services were involved, and all those goods, most of them were capable of being distinct from each other. But what happened under the contract with the hospital? Under the contract with the hospital, those goods and services were not distinct in the context of that contract. So because one was being satisfied, but because second criterion was not being satisfied, so that's why within that contract there was only a single performance obligation. In this contract, there was only one single performance obligation. Okay, let's have a look at another example. For example, on 1st January 2015, on 1st January 2015, so I think there is some issue. Let me resolve it. Let me open a new document, blank document. Okay. On 1st January 2015, you enters into a contract for a mobile phone with a telecom company on the following terms and conditions. Number one, you will receive a free handset. This is the date of the contract. You will receive a free handset. Please remember, this example will continue as we go along other steps, as we continue with the other steps. Free handset on 1st January 2015, and you will have to pay rupees 2000 per month. This includes hundreds of free minutes, and you are billed on the last day of each month. You can buy the same phone set from the telecom company for rupees 5,000 without the payment plan. You may also enter into payment plan without the handset, in which case you will have to pay rupees, instead of 2,000, you will have to pay 1,750. In this case, there are two distinct performance obligations. Number one, is the obligation to deliver handset. Number two, the obligation to provide network services for 12 months. So there are two distinct performance obligations in this contract. The obligation to deliver a handset would not be a distinct performance obligation if the handset could not be sold separately. But in this case, because the handsets are sold separately, so that's why within this contract there will be two performance obligations. Okay. This was our step number 2. Do we have any question? Before moving to step number 3?
Yeah, there are a few questions.
Yes, please.
Okay, so Altaf Jamal Khan is saying that a company is selling industrial goods and products to industry to make a value-added product. In that case, performance obligation is applied on complete value chain.
Performance obligation, no, you will have to analyze that value chain. Within that value chain, if there are goods or services which are distinct from each other and that are distinct in the context of the contract as well. If these two criteria are being met, then those goods and services will be treated as separate performance obligation. You cannot treat the whole value chain if these two criteria are being met as a one performance obligation.
Altaf Jamal also wants that you should use some consumer good example as well.
Consumer goods, I just mentioned an example of a telecom sector whereby a telecom company offered a package under which you will be receiving a free handset and you will have to pay 2,000 free handset plus mobile services for 12 months if you agree to pay them 2,000 per month for next 12 months. And you will be enjoying many free minutes on the net, off the net. So this is a package. Now we will have to see within this contract, is there one performance obligation or are there many performance obligations or more than one performance obligation? See, if handset can be bought separately and as a result you will have to pay a lower monthly rental, so this means there are two performance obligations. But if you cannot get that package without that handset, you will have to buy that handset as a compulsion. So then this is one performance obligation which covers both items.
Right. Deepak Tekmani is asking, what about the 3-year period? Don't we defer the revenue and allocate it according to the period for last two obligations?
Deepak, you are talking about which example? Please clarify.
Mohsen Ijaz Ahmed, and we will move on to the next question. Mohsen Ijaz is saying the hospital construction example, assuming if there were different construction milestones or phases mentioned in the hospital construction contract, then would it satisfy difference performance obligation relating to completion or different milestones?
See, number 1 criteria is being met. Now the question is whether number 2 criteria is being met or not. Can we distinct them in the context of the contract? If the answer is no, then that will be a single performance obligation. That will not be a separate performance obligation. Like you are building emergency section, then few wards and things like this. Those are physically distinct. But if all are being covered under a single contract and they are not separable, so then you do not have the option that at any point in time you say, okay, I'll go for the emergency section to be built by some other builder. You have to give the whole construction under that contract to one party, so that is those performance obligation will be one. That performance obligation will be one.
Alright, Deepak is clarified that he was talking about step 2 example of software and technical support.
Yes,
So,
please.
should I repeat the question now?
Yes, please.
Okay. His question was, what about the 3 years period? Don't we defer the revenue and allocate it according to the period for last 2 obligations?
Yes. Yes, it's right.
Adam Bhatti is asking, could you please elaborate whether services provided in education sector like tuition fee, hostel occupancy and meal satisfy criteria of being distinct? Could you please elaborate whether services provided in education sector like
See, in education sector, again, this will depend on the contract. For example, let me have some free space here. For example, if a student is admitted to the college and it is mandatory that he will have to utilize the hostel facility. Of course, fee for the college, but it is must that he cannot use private hostel. So then this will be a single performance obligation. But if within the admission terms and condition it is written that if the student wants to avail college on hostel facility, fine. If he wants to avail some other hostel facility which does not belong to the college, that is the choice of the student, then these will be two different performance obligations. Deepak, I hope it was Deepak or somebody else who asked us. Deepak, I hope it should be clear. See, Deepak, there are two things. Number one, the products, goods, here in this case, services. Okay, services are distinct. Services are distinct. And the second is, services should be distinct in the context of the contract. In the context of the contract. Context of the contract. When terms and condition of admission to a student says, okay, he will be paying college fee, he will have to use college hostel. So, number one is being satisfied because hostel services are distinct from the college services. Hostel services are distinct from the college services. Because see, if we go into the details, see, student can benefit from the hostel either on its own or together with the other resources. For example, the student can benefit from the college admission either on its own or together with the other resources that are readily available to the student. So first condition is being met. Hostel is a separate service and teaching is a separate service. But both conditions should be met. If terms and condition of admission of a student says that he will have to use the hostel services of that particular college, this is must for that student, then second criteria is not being met. So as a result, both criteria must be met in order to declare those goods and services as a separate performance obligation. Deepak, I hope it should be clear.
Adam Bhatti. This was Adam Bhatti's question.
Adam, I hope this should be clear.
I think we should move on to the next question. Mohammed Ahmed Siddiqui is saying, what will be the treatment of developers who provide the land and constructed villa or flats but receive installments against the property?
So that will be a single performance obligation. That will be a single performance obligation.
Bilal Tahir has the next question. He's saying, in the above example of hospital construction, if the construction starts at year 0 and completes at year 3,
Okay.
will we record the revenue and expenses in year 3?
No. And so far as the principal, that whatever, it will depend on the stage of completion. It will depend on the stage of completion. Here we are discussing only one point. See, in step number 2, we are discussing within our contract how many performance obligations are there. Why we need to identify different performance obligation, so that the total price of the contract could be allocated to each performance obligation. If there is only one performance obligation, then there is no need of differentiation. So in step number 2, we are only establishing or trying to understand how many performance obligations are there. So we discussed, if 2 criteria are being met, then there will be different performance obligation. If any of the criteria is not being met, then contract constitute a single performance obligation. Bilal, I hope it should be clear.
The next question is from Altaf Jamal Khan. He's saying, if we sell a product on credit for 90 days with warranty or on cash flow, or on cash, how we distinguish the performance obligation, and at what price we recognize the revenue in P&L?
See, when you sell something, say a product, so this is a single performance obligation. This is a single performance obligation. So far as the delay in payment is concerned, there we will consider, is there any financing arrangement? Is there any financing element which is incorporated within this transaction? But so far as the number of performance obligations are concerned, that will be 1.
Okay. Altaf Jamal Khan is asking the next question, saying, please also explain this in terms of export sales on FOB and CIF terms.
Who is he?
Altaf Jamal.
This does not make any difference. This does not. If you are selling single product, so that is your single performance obligation. That is your single performance obligation. Each contract will be a single performance obligation. But if within that contract you are supplying 2, 3, 4 items, so then that contract will constitute that number of performance obligation. Whether you are selling locally or exporting, that does not make any difference.
Amir Sikandar is saying, in engineering contracts, do we need to consider each element of BOQ separate performance obligation, or treat contract as a whole?
No.
As one performance obligation?
No, you will have to treat each element separately. You will have to treat each element separately.
And Nasser Ali has asked the last question, saying, what's the reason that those performance obligations can be mentioned independent in the contract, in the context of the contract?
So that the price of the whole contract can be allocated to each of the performance obligation. Should we move?
Yes. Zishan Hafiz is asking if we are approaching any break. I think we take a break for prayers in about half an hour.
Yes.
For those who have to still have a break. Okay. We take a break in half an hour.
Okay. Fine.
Noman Virakat asked another question. If there are different contracts interlinked with each other, then how would we recognize revenue and performance obligations?
If there are different contracts interlinked with each other, then you will have to decide whether each contract is a new contract or is only an extension of the existing contract. If it is a new contract, that will be a separate performance obligation. And if it is only an extension of the existing contract, so that will be treated accordingly.
That's about right.
Okay. So let's move to step number 3. Step number 3 is determine the transaction price. Determine the transaction price, and in the determination of the transaction price, the amount of consideration that an entity expects to be entitled to excludes amounts collected on behalf of third party, for example, government taxes. As we know that, for example, if we sell a good for rupees 100 and there is a sale tax amounted to rupees 10, say. So our revenue will be credited with 100 and sales tax payable will be credited with 10. Say we received cash from customer 110. So this means excludes amount collected on behalf of a third party, for example, government taxes. So normally we have the practice of excluding them. Transaction price might include number one, variable or contingent consideration, estimated as either the expected value or the most likely amount, to the extent that it is highly probable that a subsequent change in the estimated variable consideration will not result in a significant revenue reversal. See, examples of variable consideration are discounts, rebates, refunds, price concessions, credits, and penalties. You will be taking into account all these things right at the start of recognizing revenue from the fulfillment of the performance obligation. Depending on which method better predicts the amounts to which it will be entitled, measure variable consideration by using either the expected value. When you will use the expected value, we all know that expected value is the sum of probability weighted amounts in a range of possible consideration amounts. So this method will be appropriate estimate of the amount of variable consideration for a large number of contracts with similar characteristics. And the most likely amount, this is the single most likely amount in a range of possible amounts, that is the single most likely outcome of the contract. This may be appropriate if the contract has only two possible outcomes. For example, an entity either achieves a performance bonus or not. So there you will be using most likely amount. Remember, but amount recognized is constrained to that being highly probable that a significant reversal in cumulative revenue recognized will not occur. So let's understand it with the help of a few examples. Please go to example number 3. Example number 3, in order to understand the first point. Example number 3. I suppose it should be here. No. Example number 3 is, yes, there. Example number 3. This is example number 3. Should be here, I suppose. Yes. An entity enters into a contract with a customer to build an asset for 1 million. In addition, the terms of the contract include a penalty of 100,000 if the construction is not completed within 3 months of a date specified in the contract. The entity concludes that the consideration promised in the contract includes a fixed amount of 900,000 and a variable amount of 100,000. So this is the variable consideration. Now let's move to another example. Three A. An entity enters into a contract with a customer to provide a weekly service to clean a customer's offices for 1 year. The contract is signed on 1st January 20X1 and work begins immediately. The entity concludes that the service is a single performance obligation because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. The services transfer to the customer over time and use the same methods to measure the progress, that is time-based measure of progress. This means that if you are providing services which are substantially the same and that those will be transferred in the same pattern, so that series of distinct services can be clubbed as one service. Okay. This is one factor which you will be considering in the determination of transaction price. Second factor is non-cash consideration. Non-cash consideration. See, we have example on this. An entity enters into a contract with a customer to provide a weekly service to clean offices for 1 year. The contract is signed on 1st January 20X1 and the work begins immediately. In exchange for the service, the customer promises 100 shares of its common stock per week of service, a total of 5,200 shares for the contract. Mean for each week service, 100 shares. The company will receive 100 shares, and there are 52 weeks in a year. So over a period of 1 year, the company will receive as a consideration 5,200 shares from the company. The terms in the contract require that the shares must be paid upon the successful completion of each week of service. Here the entity measures its progress towards complete satisfaction of performance obligation as each week of service is complete. To determine the transaction price and the amount of revenue to be recognized, the entity measures the fair value of 100 shares. Fair value of 100 shares that are received upon completion of each weekly service. The entity does not reflect any subsequent changes in the fair value of the share received or receivable in revenue. So this is an example of non-cash consideration. When you receive non-cash consideration, simply recognize that non-cash consideration at the fair value at the date you completed the related service. Subsequently, if there is any change in the fair value of that non-cash consideration, that will not affect the revenue subsequently. Do we have any question? Okay.
Yeah, there are 3 or 4 questions. Shahzad Adnan is asking if it is possible that ACCA provides complete IFRS software based to its members. Shahzad, let me check that. I remember some time back there was an offer by ACCA to all its members to purchase a soft copy of the IFRSs, but I'm not sure if it's still there. Numan Liaquat is saying, what is the extent of existence contract and I think he's got this English. So I'll try to make something out of the question. He's saying, what is the extension of existence contract and how performance obligations would be recognized as some of the obligations we recognize in contract 1 and further will be completed in second contract.
Noman, I shall be discussing it separately. I note your point because I have two examples on this. In order to explain this, you mean if there is a modification in the contract. If there is a modification in the contract, so I will be explaining it. Please, modification. Please remind us once I complete 5 steps. So I'll be explaining it with the help of examples.
Imran is asking, should we write the answers of the examples or should be sent to us? I think by the end of the session we'll send out.
Yes, we will be sending them. But Imran, see, examples are complete in themselves. For example, those illustrations which I sent to you people, they discuss the whole stuff. But anyway, if anything remains, that can be sent to you people after the session.
Okay, Nasser Ali is saying, how can these shares be booked in the service provider's books?
In the service provider, so very simple. For example, this on the completion of first week, you received 100 shares from the entity. So you will see what is the fair value of these shares. What is the fair value of these shares? Say fair value is like rupees 500 per share. So at the end of first week, the entry will be this is your financial asset debit. This will be 50,000 and credit revenue 50,000. So subsequently, this will be treated in accordance with the IFRS 9. That's it. Is it clear, Imran?
Alright, meanwhile we should move on. Imran is saying, thank you.
Welcome, Imran.
Aaron Bhatti is asking, if university receive advance fee but there may be chance when the students are taking full service or not, whether amount received should be booked as revenue or should be deferred?
See, we have discussed this criteria. Okay, let me go back. Who is this gentleman?
Aaron
Bhatti. And Bhatti, see, this is the criteria. If consideration has been received, for example, you have received 100,000 from a student, but the contract criteria must be met. Revenue is recognized only when either this happened or this happened. For example, entity has no remaining obligations, so this is quite straightforward. Like you have completed whatever services you agreed and they have obtained from you the full services, okay, fine. Another is the contract has been terminated and the consideration received is non-refundable. Only in these two situations you can recognize that advance as a revenue. Otherwise, that advance will be recorded as a liability, mean advance from the student, and will be transferred to the revenue as you provide them the services.
Okay.
Mr. Bhatti, I hope it should be clear.
Yes,
You will.
it's clear. Jamal Ahmed Khan is saying, what if the revenue receiving company receiving consideration, the FE of the shares go up in the middle of the financial year?
Who is this gentleman?
Jamal Ahmed Khan.
Jamal, see, once you pass this entry, then revenue, this will be your revenue, and now you have 100 shares, for example, 100 shares, and fair value changes. It may go up, it may go down. So that will not affect your revenue. That change will be treated in accordance with IFRS 9, because this financial asset will appear in your assets. So any change in this in its value will be treated in accordance with IFRS 9, which will be discussed in the next sections.
Khurram Shehzad Yusuf is very unhappy. He had to leave because there's no electricity in his area, and he's saying that God bless our country. We'll try to upload the recording of this session as soon as possible, so that and right now as we speak, the recording of previous session, of yesterday's session, is being uploaded. So we'll try to upload these as soon as possible, so that people who miss certain part or were unable to attend, they should immediately be able to then have an access to the recording. Hamza is saying he hasn't received answers for the last Saturday session. They've all been emailed. Please check your email. Samir is saying the Mars and lunch break. Like I said, in another 10 minutes we'll take a break. That's it.
Okay. So then is consideration payable to customers. Consideration payable to customer. Please go to the example number 5. Go to the example number 5. So we can go here on example number 5. Example number 5 says an entity that manufactures consumer goods enters into a 1-year contract to sell goods to a customer that is a large chain of retail stores. The customer commits to buy at least 15 million of products during the year. The contract also requires the entity to make a non-refundable payment of 1.5 million to the customer at the inception of the contract. The 1.5 million payment will compensate the customer for the changes it needs to make to its shelving to accommodate the entity's products. The entity concludes that the payment to the customer is not in exchange for a distinct good or service that transfers to the entity. This is because the entity does not obtain control of any rights to the customer shelves. Consequently, the entity determines that in accordance with IFRS 15, the 1.5 million payment is a reduction of the transaction price. So this means in this case the transaction price in case of example 5 will be 15 million minus 1.5 million. So the transaction price will be 13.5 million. So this means if you have to repay some amount to the customer, then you will reduce your transaction price, your revenue, by that amount. Then is time value of money. Then is time value of money. Okay. Time value, before going to the time value of money, let's see another example related to the refund liability. So that's related to the variable consideration. So we have an example 4. Example 4. See, an entity enters into 100 contracts with customers. So I'll be explaining this example with the help of journal entries, and so that you could understand the whole cycle in this case, because this is very common in the industry where you refund the customer for any goods returned. An entity enters into 100 contracts with customers. Each contract includes a sale of one product for CU mean currency unit, $100 or rupees, whatever you say. So 10,000. Cash is received when the control of a product transfers. The entity's customary business practice is to allow a customer to return any unused product within 30 days and receive a full refund. The entity's cost of each product is 60. This is the cost of the product. This is the sale price. And this is the number of the products to be sold under this contract. Because the contract allows a customer to return the products, the consideration received from the customer is variable, to estimate the variable consideration to which the entity will be entitled, the entity decides to use the expected value method, because it is the method we can recall that we can use either of these two methods, either expected value method or most likely amount. So I think I can go for a pop-up on this. Mr. Harun, can you please help me? I'll make you write a pop-up question, very short pop-up question for the audience, so that we could see that audience are with us or not. If the contract okay, can you?
Yes, the question.
Okay. If a contract has only two possible outcomes, then it may be appropriate to use, number one, this is option number one, the expected value. Option number two, the most likely amount. Yes.
Two options.
Yes.
Should I launch this?
Yes.
On the screens. Question is up on the screens.
Question is up on the screen. Please, you have 1 minute to answer this question.
About 5 seconds left. Go please submit your answers. All right. Okay, so it's actually a 50-50.
Okay.
55% of the people said the expected value. 45% of them said the most likely.
45% are correct. This will be the most likely amount. Please, for those 55% who answered it incorrectly, please note that. If the contract has only two possible outcomes, for example, an entity either achieves a performance bonus or no, or not, there are two possible outcomes. So their most likely amount is the most appropriate method. But if there are many large number of contracts with similar characteristics, so there you can use the expected value. So please remember this. Okay, let's come back to our question. So expected value, because it is the method that the entity expects to better predict the amount of consideration to which it will be entitled. So they might have sold these products to many customers. So there were large number of similar contracts. So on the what they did, they calculated the expected value of the outcomes of those contracts. And the entity estimates that 97 products on the basis of expected value method, products will not be returned. Upon transfer of control of the 100 products, the entity does not recognize revenue for the 3 products that it expects to be returned. Consequently, in accordance with IFRS 15, the entity recognizes the following. Revenue 9700, 300 for 300 are refund liability, revenue 9700, and this is the asset and this asset will be named as right to recover products from the customers for 180. So once we will be back from break of Zuhur prayer, so I shall be explaining how will it be presented in the financial statement. Like I'll be explaining the whole scenario through journal entries, not how will it be initially recognized, but what happens subsequently if you if the customer returns 4 products instead of the estimated products of 3, or if the customer return fewer products than the expected. So we take a break for 15 minutes. So we will be back after 15 minutes. uh, I'll I'll be I was explaining example number 4. So contract involved 100 items, and the sale price of each item was also 100 rupees or dollar, whatever you want to say, and the cost of each item was 60. And on the basis of expected value method, they estimated that 97 products will not be returned. 97 products will not be returned. So what they did, so as a result, they recognized revenue of 97 products and a refund liability of 3 products and an asset of 180 right to recover the products. So what will be the entry for this? The initial entry will be for recording of revenue. For recording of revenue, the entry will be, because we have received the cash, debit, cash account, we have received 10,000. So 10,000 will be debited, credit, revenue for 97 products, that is 9,700, and the remaining amount is our refund liability. And that is for 3 products. So this is the entry for revenue. Number 2, for recording of related cost of sale, the entry will be debit cost of sale, account. 97 units were sold, so cost of sale will be debited with the cost of the 97 unit, because this is cost of sale into 60. This will give us 5820. Then stock will be credited, credit stock, because from stock 100 items were out, so 100 units into 60, this amount of 6,000 will be credited to the stock, and the balancing amount will be our asset, and that asset is the right to receive returned goods, account 180. So this will be the second entry. For recording of revenue, this will be the entry, and this will be the second entry for recording of related cost of sale. Okay, if subsequently say if subsequently 4 items, So this was the initial recognition. I am drawing a line just to separate it from this second scenario. 4 items were returned. 4 items were returned instead of 3. Instead of 3, which we initially estimated. See, if 3 items are returned subsequently, the entry is very simple. I will be using another color just to highlight. If 3 items are returned, then what will be the entry for that? If 3 items are returned, if 3 items as we estimated are returned, so simply this refund liability will be debited. Refund liability will be debited with 300, and we paid them back 300. So cash will be credited. This is one entry. Second is debit stock, because we have received stock of 3 items. So stock will be debited with 180, and credit asset. I have not enough space here to write the whole duration here. So asset will be credited with 180. So these will be the entries if the customer actually returns the estimated 3 units. But let's see, if 4 items were returned instead of 3. 4 items were returned instead of 3. So what will be the entries? Number 1 entries will be debit refund liability, debit refund liability with 300, debit and credit cash, because customer returned 4 items, so we paid them 400, and the remaining amount will adjust our previously recognized revenue. This is the first entry related to the revenue. Second entry will be, because we have received stock, so debit stock, we have received 4 items, so 60 into 4, 240 debit, and credit will be asset, the same asset which we created, the right to receive. The right to receive returned goods. The right to receive returned goods, account credit 180, and the balancing figure will go to cost of sales. This will have the effect of reduction of cost of sale, because cost of sale was for 97 units, whereas out of those units 1 unit is returned, so cost of sale will be reduced, and likewise revenue will be reduced. So this completes initial recognition and the subsequent effect. So if we have any question related to this example, so please feel free to ask before moving to the next example.
Ajit Kumar is asking if there will be no return, then what entry should be made to record revenue?
If there is no return,
Yeah.
so of course that after like a period of refund, you will record that refund liability as a revenue, and likewise you will increase your cost of sale.
Nasser Ali
Ajit,
had
I
the same-
hope it should be clear.
Nasser Ali had the same question as well, so that's answered. Any further questions, please send them in now.
Okay.
Yes, Muhammad Ahmad Sheikh is saying, can entity impose restriction on number of goods returned?
Yes, those can be imposed, but this is not the normal case. Okay, so let's move further.
Maria Iqbal is saying, if less than 3 items were returned.
So accordingly, Maria, if less than 3 items are returned, see this refund liability, the entry will be, refund liability will be debited with 200. You will be paying cash for 200, and the remaining amount in refund liability of 100 will be transferred to the revenue. And likewise, this asset 120 stock will be debited with in case of 2 items 120, and this asset will be debited with 180, but the difference between 120 and 180 will be debited to the cost of sale. See, when Maria can कब से है ऐसे? Can you ask them? Can we ask them? Continue. Okay, Maria, I'll answer your question again, so I can make entry for you here with a different color. Okay, I use here green color. Like Maria, 2 items were returned instead of 3. So the entry will be credit cash 200, debit refund liability. Please, refund liability after that period, till then goods can be returned, refund liability should no longer be there. So refund liability should be debited with the full amount, that is 300, because if you can see that we credited the refund liability with 300. So once the period within which goods can be returned that is over, then this refund liability should no longer be there. So whatever is the case, like they returned just 2 items till that time, so you gave them rupees 200 as a cash, but refund liability will no longer be there. So what about the balancing figure? Balancing figure will increase the revenue with the sale price of that one item which is retained by the client, because in total client will be recognizing, you will be recognizing the revenue for 98 items. So this is your first entry. Malia, I hope it should be clear. Number 1 entry, please say yes if you understand it, so that I could move to the next entry. Maria, is it clear?
Yes.
Okay. Next is because you are returning just 2 items. So stock will be debited with the units you are returning to the stock. So 60 into 2. So this will give us 120. But after the date, till then your client can return the goods, this asset should no longer be there. So this asset will be credited with the full amount, and that is, I'm not writing the whole narration here, this asset credit with 180. So what about the balancing figure? The balancing figure will increase the cost of sale, and that is for 1 unit. So this will be the entry for cost of sale. Very simple logic, Maria. Cost of sale is increasing with 1 unit cost, and revenue is increasing with 1 unit cost. Okay, any other question?
Yes, Burhanuddin Arif Ali is saying, please explain a sample illustration in case of warranty on certain product.
Yes, I hope we will be discussing that in the coming examples.
Okay. Ajit Kumar is saying, can you please write the entry for less than 3 items returned? So I think
I just explained for Maria. Ajit, I hope it should be clear to you.
Yeah.
Okay. Okay, now we discuss another scenario. Time value of money. Time value of money. So again, we will understand this time value of money concept with the help of an example. This standard says transaction price should incorporate if there is a significant time value effect. Okay, let's go to the example number 5. Example number 5A. Example number 5. We should have 5A here. Okay, let me check. Is it on the top of this? No. Okay. So I'll read for you. This is not a very long example. Few figures are involved. An entity sells a product to a customer for $121. Okay, I'll be writing it here in a very summarized form. Okay, I can use another page for this purpose. Okay. So an entity sells a product to a customer for $120. This is the sale price. And the amount is payable after 24 months. After 24 months. The customer obtains control of the product at contract inception. The cash selling price of the product is $100. This is the cash selling price. Cash price, which is $100. The entity's cost of the product is $80. Cost of that product is $80. See here, why this 121, whereas the cash price is 100? This means the contract includes a significant financing component. In accordance with IFRS 15, this is evident from the difference between the amount of promised consideration of $121 and the cash selling price of $100 at the date the goods are transferred to the customer. The entity evaluates the rate and concludes that it is commensurate with the rate that would be reflected in a separate financing transaction between the entity and its customer at contract inception. So the following entries will be made for this. Instead of 121, revenue will be recognized $100. Receivable $100. Instead of 121, revenue will be recognized by $100. And of course, cost of sale is simple in this case. Cost of sale will be $80 and credit stock $80. See, subsequently, this revenue will not change. This receivable, until the entity receives the cash payment from the customer, the interest revenue would be recognized in accordance with IFRS 9 in determining and further how you will calculate the effective interest rate, and that will also be calculated in accordance with IFRS 9. And so this is this way you can recognize the time value of money factor. You can incorporate time value of money factor in the determination of the transaction price. If we have any question, I can answer those questions. Do we have any question, or should I continue?
There are two questions.
Yes, please.
Musa Al-Rayami is asking, what about recording revenue from dividend? When we recorded the dividend as receivable from the date of declaration, or the cut-off date of the dividend, or the conducting of annual general meeting?
Nusa, when the shareholders are entitled to receive that dividend, that will be the date at which you will be recognizing that dividend.
Muhammad Arsalan Abbas is saying, what if the companies use this method to decrease their revenue in a reporting period, while actually there was no risk of return?
Who is this gentleman?
Muhammad Arsalan Abbas.
Muhammad Arslan, you are talking about the previous example related to the 100 units. Please say yes or no. Arslan, are you talking about?
Yes.
So can you repeat the question?
Alright, the question is, what if the companies use this method to decrease their revenue in a reporting period, while actually there was no risk of return?
This could be the possibility, because estimates are involved, judgments are involved. This could be the possibility. This cannot be avoided. Of course, again, hopefully the auditor will be able to point it out.
Muhammad Abrar is saying, after adoption of IFRS 15, all projects financing deals need to identify the financing element in projects in order to classify.
Yes, you will have to. And the date is not very far. See, 1st January 2018.
Monica Rani is asking, sir, can you please explain again the difference between cash price and sale price?
Okay, no problem. Monica, see, I hope Monica, this was the case where an entity sells a product for 121, and the customer will pay at the end of, after 24 months. But its cash price is $100. So the difference between these two components, between the cash price and 121, because the customer will be paying after 24 months. So this reflects the financing component, significant financing component. Standard says separate this financing component. Now the question arises, we need to calculate the effective interest rate for this purpose. Of course, effective interest rate. In order to make this example simple, so I have just assumed here effective interest rate, but you need to calculate from practical point of view effective interest rate. So on the basis of that effective interest rate, you will be calculating 121's present value. Here we are assuming, okay, if effective interest rate is, I assume from the figure it seems effective interest rate is 10%. 121 divided by, yes, here I have assumed effective interest rate of 10%. When you know that you are selling a product with a significant financing element, so what you need to do, you need to discount, you need to calculate the present value of that amount. And the present value of that amount is 100, which is the cash price. So your revenue will be booked with the present value of the receivable. I hope it should be clear.
Okay, there are more questions coming
Yes.
in. Abdul Mutalef is asking, sir, how the difference of $21 reflect in books of accounts?
Yes, initially, see, you have not received anything. 121 will be received at the end of second year. So what will happen? Initially, only you pass. His name is Abdul Manaf Mutalif. I hope I pronunciated it correctly. See, this will be the initial entry. At the end of year 1, what will happen? See, as a result of this first entry, your receivable will show like 100. At the end of year 1, what you will do, you will pass another entry, debiting receivable, and credit your finance income. Finance income means profit and loss account. Profit and loss. With unwinding of this asset. So that will be 100 into, because your effective interest rate is 10%. So this will give you 10. This will give you 10. At the end of first year, say your year end is 31st December, year 1. So this will give you the finance income of 10. So closing balance of year 1 will be 110. And in second year, because the opening balance is now for second year is 110, you will be passing the same entry, receivable debit, but now with 110 into 10%, which will give you 11, and likewise here you will mention 11. So this will give you 11 at the end of first year. So at the end of second year, this will be 121, and if you receive the cash, so this account will balance. I hope your question, you are clear about your question.
The next question is from Ikram Rajan. He's saying our organization sold industrial plots at par rupee 5.6 million, and 20% shall be paid as down payment. The remaining amount shall be paid in 8 equal installments.
Okay.
The possession shall be given to the allottees after meeting terms and conditions. In this case, at what time the revenue shall be recognized?
See, this is this will be recognized at the time when you entered, right at the start, when you entered into the agreement, whereby you agree with them that whatever amount they will be paying in the form of advance, and the breakup of the installment is agreed with them, you will be recognizing the revenue at that point in time. But you will have to see the other terms and conditions. What you expect? Maybe there are other terms and conditions that they can return this plot to you people, or you may need to develop this plot. So this depends on the other terms and conditions as well. But if you can tell me very briefly what are the other terms and conditions, so I can give you the idea. But from prima facie, you will be recognizing the revenue at the time you entered into the contract. But by incorporating any significant financing component effect.
Right. Rana Hafiz is asking what entry will be if we receive 120 at the end of the period. We create receivables at 100. How can we balance the figure?
Sorry, again, Rana Hafiz, please.
What entry will it be if we receive 120 at the end of the period?
Okay, if you receive the amount early, see, if you receive the amount early, see, if you receive the amount early, so this will be your other income, this will be your other income. That's it. Okay, let's move further. So this was the time value.
There were a couple of more.
Yes, please.
Altaf Jamal is saying, considering the time value of money in my company, we have different prices based on payment terms. Different prices based on payment terms of customers. How we recognize the revenue?
Altaf, your company is a perfect case where you will have to account for the time value manufacturer.
Amir Sikandar is asking, in contracts, usually major companies use milestones method of allocating costs and revenue to each important project milestones. Number one, would milestone system qualify for appropriating the revenue to performance obligations? And also number two, milestones are not contractual but required to complete the project.
Should I answer?
Yes.
Who is this gentleman?
This is Amir Sikandar.
Amir, see, your question will be answered in step number 5. Now we are on step number 3. When we will reach step number 5, your question hopefully will automatically be answered. If this is not the case, so please ask that question again.
Muhammad Imran is saying, if a company exports and get payments through LC with terms at 24 months from bill of landing date, how company record interest and revenue?
The same way as I explained, calculate your financing element and only recognize your revenue based on the present value of the amount to be received. And the remaining amount, of course, the difference between the amount you recognized and the amount you will actually receive, this difference will be your finance income, which will be recognized over the period.
Altaf Jamal Khan is asking, revenue recognized based on cash price, as you have explained, considering the industrial practices in Pakistan, significant part of revenue after implementing this IFRS 15 shall be classified in financial income.
You are right.
Is there any other option?
You are right. Altaf, you are right.
Is there any other option?
Just I want to correct one thing. Though I have taken here cash price, but in fact I made it very simple. But the real concept is using your company's specific effective interest rate to calculate the present value of the cash receipts. So that present value will be debited, will be credited to the revenue. The difference between that present value and the amount which you actually receive, that will be the finance income which will be recognized over the period. I hope, Mr. Iftaf, it should be clear.
Okay, Muhammad Imran has a question now. He's saying, take another example of payment terms, irrevocable letter of credit confirmed by Italian bank payable at 7:30 days from bill of landing. Kindly, how we recognize revenue contract amount? How we how we recognize revenue? The contract amount is 2 million euro.
2 million euro. First, calculate the effective interest rate of your company. Then discount this amount of 2 million, and whatever is the present value, you can recognize your revenue on that present.
Abdul Muttalif has asked another question related to the previous one. Is saying, can we include LC charges in our purchase cost to reach landing costs as per IAS 2?
IAS 2? We are discussing IFRS 15, so please be relevant. I'm very sorry, please be relevant. Otherwise, we will
saying sorry for the deviation. We already asked. Alright, just a few more questions. That I think Muhammad Ali Janwar is saying, can you please check the issue with sound? I think the sound issue is fixed more or less now. Okay. There's a question from Altaf Hussain. He's saying, if we enter into annual maintenance contract for 3 years,
if we enter into
an annual maintenance contract for 3 years,
okay,
total price is 3 million for 3 years, but we receive 1.5 million at the signing of the contract. How much revenue will be recorded each year?
How much if you received?
Then 1.5 million the signing of the contract.
Okay.
The total value of the contract is 3 million.
3 million, and you receive 1.5 million in advance.
How much revenue will be recorded each year?
How much revenue? Of course, 1 million will be recognized in each year, but you have received 0.5 million related to the second year. So you will be recognizing 1.5 million as an advance. But at the end of the first year, the revenue to be recognized will only be 1 million, and that will be for each year.
Okay. Muhammad Imran is saying, how will we split the effect of time value of money? And then saying, okay, thank you.
Welcome. Yes.
One last question. Abdul Muttalif is saying, meaning when we buy goods from a supplier, we open LC for 60 days, say. Bank charges for LC opening and any discrepancy, can this be included in the cost of goods?
If these are directly attributable and these are not abnormal costs, then these can be, anyway, this relates to ICT.
Okay, Muhammad Imran is saying the above examples were from supplier perspective and how we treat these from the customer perspective.
Customer perspective. Who received the goods, in fact. Who received the goods. For him, because he will be paying after 24 months, so he should also apply IFRS 9. This is financial liability. He will be recognizing it, keeping in view his effective interest rate. Assuming if his client effective interest rate is again 10%, so he will be recognizing this liability at 100, and on unbinding, a finance charge will be transferred to the profit and loss account. I hope it should be clear.
Altaf Jamal has the last question, and after that we should continue.
Okay.
Altaf is saying, if a company has distributors and direct customers both, and prices are based on their terms, still the same will apply? And then he's saying, because of different value chain, the prices are different for distributors and direct customers.
No, see, Mr. Iltaf, the concept is, if you have incorporated the financing element in the transaction just because of the delays in the payment, whether you are supplying to normal customer or to distributor, that does not affect this decision. The decision will be based, have you incorporated the financing element in your transaction? Had it been the case, so then you will have to apply this principle. Okay. Now, step number 4. In step number 4, we will allocate the transaction price to the separate performance obligations, based on the relative standalone selling prices of the goods or services promised and is made at the inception of the contract. See, if there is only one performance obligation, step number 4 will not be applicable in a sense that will be obvious that the whole contract price relate to this single performance obligation. But if there are more than one performance obligation, then you will have to allocate the total price to each of the performance obligation. And this will not be adjusted subsequently. And you will have to see certain other matters. Having estimated the total consideration we are going to receive under the contract, we need to allocate the transaction price to each of the identified performance obligation. And we do that on the basis of relative stand-alone selling prices of each of the distinct products or services identified in the contract. This step is really only an issue when contract involved group of services. Much contract normally involve multiple goods followed by related services or multiple services. The transaction price must be allocated to each of the separate performance obligation so that the revenue is recorded at the right time and in the right amount. Now the best approach is standalone price that the entity charge for that good or service when it sells separately in similar circumstances to similar customers. However, goods or services may not always be sold separately. If that the case and the supplier does not actually have standalone selling price, the net selling price need to be estimated derived by other means, which obviously going to involve quite a bit judgment. There are methods you can use to allocate or estimate standalone selling price, and we can apply an estimated margin approach, which is an estimate of what we think is the cost of the particular goods or service would be, again plus an appropriate margin. There is a usual approach which can be used in some particular circumstances. The important point to note is there is no such thing as a free lunch. Once we identified the individual performance obligation, the total transaction price must be allocated to all of those obligations. We cannot apply all the consideration to any one particular performance obligation. And further, discounts and variable consideration are allocated on a rational basis. So we can understand with the help of an example, as we started an example of telecom sector. If you just remember, we started that example. I can use this slide. On 1st January, if you remember, on 1st January 2015, you enters into a contract for a mobile phone with a telecom company on the following terms. One was for free handset, and second was 12 months mobile services. And against these two, you will be paying rupees 2,000 per month. And further, as we discussed earlier, you can buy the same phone set from the telecom company. That phone set can be bought separately. Set can be bought separately. for rupees 5,000 without the payment plan, without this service. So as we discussed earlier, that this contract constitutes two performance obligations. This is performance obligation number 1, mobile set, and this is performance obligation number 2. Now there are two performance obligations, and the contract price is 2,000 per month. This means contract price is, total contract price is, please note these figures because I will continue with this example in order to explain the later steps as well. Contract price is 12 into 2,000. So your contract price is 24,000. Now, how will we apply step number 4? Step number 4 says we need to allocate this 24,000 among performance obligation number 1 and performance obligation number 2. So we will use their standalone selling price. Assume we know that what is the standalone selling price. Their standalone selling price, we are assuming that we know this. For performance obligation 1, which is handset, and then performance obligation number 2, which is mobile service for the whole year. We are assuming, I am repeating it again and again, I am assuming that we know that this is 5,000 as I mentioned here, and this is 21,000 mobile service. So this means in total 26,000. Whereas the amount which we will receive is 24,000. Standard says this 24,000 will be allocated between performance obligation 1 and performance obligation 2 in this ratio. So what is that ratio? That ratio is for a handset 5,000 divided by 26,000. So this will give us 19.23%. I think I should change the color. I hope I will be able to do this in color. I should use okay, black. Then for mobile service, 21,000 divided by 26,000. So this will give us approximately 80.77%. So we will multiply this 19.23% with 24,000 to calculate the revenue allocated to the handset, and 80.77%, let me calculate it, 80.77%, 19,385 related to the mobile service. So this was the step number 4. What we did, we calculated, okay, this was our total amount which will be received over a period of 1 year. So what is the breakup? How will it be allocated among performance obligation 1 and performance obligation 2? We used standalone selling prices in order to calculate the breakup of this amount. If this standalone selling price is not available, then you will be using other methods. Like if observable price is not available, then estimate the price by using observable inputs, like what is the estimated cost of providing that service or good, and with the addition of an appropriate margin. And likewise, in limited circumstances, like you can use other methods as well in order to estimate the costs of different services which are being provided. Okay. Step number 5. Step number 5 is, this is a very important step. Again, this involves much technicalities. Step number 5. If you people have noted this, I would like to raise the data from this slide so that, can I raise this data? Please answer with yes. Though we will be receiving a lot of yes, I hope, but this will help us in.
Yes.
Okay, fine. I can remove this data with reason. So step number 5. This is the last step, and very important step, especially those members who are involved in the construction industry. This step is very important for them, because this step will tell them the timing of the recognition of the revenue. Normally, we used to recognize the revenue in case of construction contracts over a period of the time. But now there are certain changes which could have significant effect so far as the timing of the recognition of the revenue is concerned. Okay, step number 5. Step number 5. Step number 5 says, revenue to be recognized as each performance obligation is satisfied by transferring a promised good or service to a customer. Okay. Step number 5. Revenue to be recognized as each performance obligation is satisfied by transferring a promised good or service, that is an asset, to a customer. An asset is transferred when or as the customer obtains control of that asset. Control of an asset refers to the ability to direct the use of. So let's understand control. Ability to direct the use of and obtain substantially all of the remaining benefits from the asset. Control includes the ability to prevent other entity from directing the use of and obtaining the benefits from an asset. So, what is the meaning of benefits? Benefits. The benefits of an asset are the potential cash flows, inflows or savings in outflows that can be obtained directly or indirectly in many ways, such as by using the asset to produce goods or provide services, including public services, using the asset to enhance the value of other assets, using the asset to settle the liabilities or reduce expenses, selling or exchanging the asset, pledging the asset to secure a loan, and holding the asset. Okay, so these are the examples of the benefits. So if you have the ability to direct the use of those benefits and the ability to prevent other entities from directing the use, then this means you have obtained the control. Before moving further, I would like to discuss some special circumstances like repurchase agreements. Now the approach is very simple. These will fall under three situations. An entity has an obligation to repurchase the asset. Compulsorily, the entity will have to repurchase that asset. Second, the entity has the right to repurchase the asset. The entity has the right to repurchase the asset. After, if you people have any question related to these two slides, what was the break time? It was 4 o'clock? Okay. At 4 o'clock, Pakistan Standard Time, we will be having a break, mean approximately after 17 or 18 minutes. So, okay. An entity has the right to repurchase the asset, a call option. An entity must repurchase the asset if requested to do so by the customer. What will be the treatment? The treatment is the entity will account for the contract as a lease under IAS 17 if the repurchase price, or you can mention here IFRS 16, if the repurchase price is below the original selling price. Very simple criteria. Just look at the repurchase price. If it is below the original selling price, for example, repurchase price is say 600,000, but you originally sold this asset for 900,000. So this will be treated as a leasing transaction. So will be treated accordingly. Or a financing arrangement if the purchase price is equal to or greater than the original selling price. A financing arrangement if the repurchase price is equal to or greater than. What does it mean? It means like if the repurchase price is say 1.2 million, if the repurchase price is say 1.2 million, but the original selling price was 1 million. So this will be a financing arrangement. You sold an asset for 1 million and you will be repurchasing it at 1.2 million. So this you will treat it as a financing arrangement. Means you will not de-recognize your asset. Your asset will continue appearing on the statement of financial position, and the cash which you received will be treated as your liability. Okay. We can use this example in order to illustrate the last situation. An entity enters into a contract with a customer for the sale of a tangible asset on 1st January 2007 for 1 million. This was the original selling price. Original selling price. This was the original selling price. The contract includes a put option, right to sell, that obliges the entity to repurchase the asset at the customer's request for 900,000 on or before 31st December 2007, at which time the market value is expected to be 750,000. What is the repurchase price? 900,000. This is the repurchase price. Purchase price. And at that date, this is the market value of the asset when this asset is being repurchased at 900,000. customer has incentive to sell the asset back to the entity. This means that control does not pass to the customer. Control does not pass to the customer. Says the customer will be exercising the put option right to sell. This limits its ability to use or obtain the benefit from the asset. So as a result, treat it as per IAS 17, the difference of 100,000 will be accounted for as a payment received under operating lease. Because this is your asset, you have given the asset, you are in fact lessor. And if I just remind you, treatment of lessor under the old standard and the new IFRS 16, both standard provides the same, substantially the same accounting treatment. So this way you will handle this transaction. Then is another example. An entity enters into a contract with a customer for the sale of a tangible asset on 1st January for 1 million. This is the original selling price. Original selling price. The contract includes call option that gives the entity the right to repurchase the asset for 1.1 million. So this is the repurchase price, which is above than the original selling price. So what we learned? We learned that again here, customer does not obtain the control of the asset. Because the repurchase option means that it is limited in its ability to use and obtain benefit from the asset. So this is financing arrangement for the entity. The entity continues to recognize the asset and recognizes the cash received as a financial liability. The difference of 0.1 million is recognized as interest expense. Further, if on 31st December possible हो सकता है कि whatever is available in that. Okay. So on if on 31st December 2007 the option lapse unexercised, the customer now obtains control of the asset. The entity will de-recognize the asset and recognize the revenue of 1.1 million. So if you people have any question, please feel free to ask before I move to the next concept. Okay, can we continue?
Yes, I think the
Okay.
yes.
Okay, so next is very important question. We need to decide whether the performance obligation is being satisfied at a point in time, at a point in time, at a point in time, number one, or being satisfied over time, being satisfied over time. We need to make this decision. Why? If it is being satisfied at a point in time, the whole revenue will be recognized at that point in time. But if performance obligation is being satisfied over over a number of years, over a number of period, then that revenue will be recognized over that period. So the standard says a performance obligation is satisfied at a point in time unless it meets one of the following criteria. In which case it is deemed to be satisfied over time. Number one, the customer simultaneously receives and consumes the benefit provided by the entity's performance as the entity performs. As I am delivering this service and this service is being consumed simultaneously. So this is an example of this CPD service. Second, entity performance. See, this is very important. It meets one of them. Either this or the third one. Or the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. Further is, the entity's performance does not create an asset, with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So within this criterion, there are two things. No alternative use, I should mention over here, please, this is important because normally people take it as one. There are two things, both must be fulfilled in order to do we have, okay, no alternative use, this is one, and number two, entity has enforceable right to the payment for performance completed to date. Enforceable right of payment.
Session over here is under.
Okay. As administrator, I think we should excuse from this interruption.
Yes, I hope you're all back. You should be able to hear us. Sorry for this disruption. There is some renovation going on at the ACC office in Pakistan, and whenever there is an electrical cut off, we are facing this little issue. But I hope you will not have this issue in the rest of the 1 hour. So, Mr. Abubakar, let's continue.
Okay, so before I continue, because we have 2-3 minutes left, if anybody has any question, I can answer very quickly a few questions before going to the break.
This question from Amjad Ali is saying if the selling and repurchase price is the same, then
Again, this will be your financing arrangement. Again, this will be your financing arrangement. Because you can see that, Amjad Ali, see here, if you see the principle is if the purchase price is equal to or greater than the original selling price. So this will be your financing arrangement. Amjad Ali, I hope it should be clear. Okay. I can check a few other questions. Okay, let's go back to our slide. See, I was discussing that no alternative use and enforceable right of payment for performance completed. For performance completed. Do we have any question? Because we have 2 minutes left before.
Mohammed Sheikh is saying kindly brief overview of the first two modules. It's in the first 50 minutes. I think they can watch the recording before the initial 50 minutes. We will upload the recording as soon as it is available, so you should be able to view the recording in, I think, by later today or early morning tomorrow. Yep. There are no further questions at the moment. Do you think we should take a break?
We can take a break for 15 minutes because this will involve lunch and prayer.
Yes, lunch and Asr prayer, and at the same time we'll try to switch our Wi-Fi connection to this as well.
Yes.
Thank you very much. I'm putting the connection on hold.
this was, we were discussing step number 5. A performance obligation is satisfied at a point in time unless it meets one of the following criteria. And I told you that within this third criteria, there are two things. Both must met. See, you can see that here, and mean both must met. There should be no alternative use, and the entity has enforceable right to payment for the performance completed to date. So, okay, let's look at the examples.
Another camera check.
Share my webcam. It is written over here. Should I click it? Okay, fine. Okay, let's look at the examples.
Can you share?
No, it's not being shared.
Yeah.
I'm clicking over here, but it's mixed. Share my webcam. I think now it is being shared. Okay. Picture. Okay. Example number 7. An entity, a construction company, enters into a contract to construct a commercial building for a customer-owned land. The entity accounts for the promised bundle of goods and services as a single performance obligation, satisfied over time because the customer controls the building during construction. If we come back to our slide, we can see that the entity performance creates or enhances an asset that the customer controls as the asset is created. In example number 7, okay. Unmuted now. Okay, in example number 7, because customer is controlling the asset during its construction, so as a result, the revenue will be recognized the revenue will be recognized over time. The revenue will be recognized over time. Okay, now let's look at the example number 8. This example says an entity enters into a contract with a customer, a government agency, to build a specialized satellite. The design and construction of each satellite differs substantially on the basis of each customer needs and the type of the technology that is incorporated into the satellite. As part of that assessment, the entity considers whether the satellite in its completed state will have an alternative use to the entity. Although the contract does not preclude the entity from directing the completed satellite to another customer, the entity would incur significant cost to rework the design. To rework the design and function of the satellite to direct that asset to another customer. Consequently, the asset has no alternative use. The asset has no alternative use. Why? Because the entity would incur significant cost to rework the design and function of the satellite. Further, for the entity performance obligation to be satisfied over time when building the satellite also requires the entity to have an enforceable right to payment for performance completed to date. Though this example does not mention anything about this second criteria, if we assume that within that agreement it is written that the entity will be entitled to payment for performance obligation completed to date, if we assume that this is there within the contract, and because of this term, entity has no alternative, the asset has no alternative use, so the revenue will be recognized over time. Okay, I can explain this with another example. Another example is, as we started the example of a mobile company. So let me see if we have that calculation with us. So I can continue with the same. Okay. If we remember, I can use some space from here. Okay. On 1st January, in order to explain step number 5, I'll be using the same example of mobile set where you enter into a contract for mobile phone with a telecom company on the following terms, like free handset, number 2, mobile services for 12 months. Mobile services for 12 months against the payment of rupees 2,000 per month. And while explaining step number 4, we calculated the revenue to be allocated to each performance obligation. So what was that? For handset we calculated 4615, and for network services or mobile services we calculated we calculated 19385, so the total will become 24,000. So at the end of first month, rather if we start from 1st January, when you entered into this agreement, what will be the entry? The entry will be debit. The entry will be debit. Company will credit revenue equal to the revenue of the mobile set, because on 1st January 2015, company provided you the mobile set, so control is transferred. So 4615, the company will be recognizing this revenue at this point in time when they transferred the control of that physical asset. So debit will be receivable account. Then the company will make entry of debit because they have issued an invoice equal to 2000. So they will debit their receivable with 2000 and they will credit their revenue. They will credit their revenue with 1615. How they have calculated 1615? They divided the total revenue. Let me change the color. This is the total revenue related to mobile service. They divided this total revenue for the whole year, 19385 with 12, in order to reach 1 month revenue related to the mobile service. At the end of the first month, they have provided you 1 month service. So they will be recognizing revenue equal to the 1 month, equal to a 1 month revenue. So this is, they are recognizing this revenue over a time. So where it will fit in within this slide, customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. When you call, whenever you call, and this service during that month, you will be charged that much amount at the end of the month, but that service is being provided over time. So that's why instead of recognizing the whole amount of 19385, which is the case of mobile set, because in case of mobile set, you received the mobile set. Company handed over you the mobile set right on 1st January 2015. This means company no longer control that mobile set. So this means that that mobile set was sold on 1st January 2015. So that's why we have recognized the full allocated amount right at the start of the year to the revenue. So far as the services are concerned, which will be received over the time, those will be recognized over time. And likewise, if we likewise in remaining months, you will be making the same entry. The balancing figure will be receivables account and this receivable account is in fact unbilled revenue. Unbilled revenue. The balancing figure will go to this account. This is the same account. In fact, you are receiving a part of this amount related to this. A part of 2,01615 for the provision of services and 385 related to the handset. Likewise, you will keep on making entry at the end of each year. Okay. Then is, if we have any question, we can answer those questions. Mr. Harun, can you please help me in this regard?
Okay, Muhammad Saqib Sultan is asking a question saying in telecoms example PO2, which is service revenue. About that, if the customer cancels the contract at any time in the contract duration, how do we treat this condition?
Right at the start of the contract, you will incorporate the effect of that cancellation within the amount to be recognized as revenue. As we did in case of like we sold 100 units, but in fact we recognized revenue for 97 units.
Sunny Kumar is asking, can you repeat how receivable of 2000 is done?
Okay. Sunny, at the end of first month, because if we look at the, what was the illustration? Illustration was basically, you entered into an agreement with a telecom company whereby two things will happen. One, you will receive a free handset. Second, you will be able to enjoy free mobile services for a period of 12 months. Against these two items, you will be paying 2,000 rupees per month. So this is the end of the first month. So you issued a bill to the customer for 2,000. So this 2,000 is receivable from the customer. Sunny, I hope it is clear.
Yes, the next one is from Deepak Tikwani. He's saying why we didn't calculate the financing part of the handset.
Financing part of the handset. See, handset you have received immediately, and the period involved is up to 1 year. So that's why we are not calculating. Okay. Another example is an entity enters into a contract with a customer to build an item of equipment. The payment schedule in the contract specifies that the customer must make an advance payment at contract inception of 10% of the contract price. Please note that an entity entered into a contract to build an equipment. Some equipment may take many months or a couple of years to complete. Okay, 10% was the advance, and regular payments throughout the construction period amounting to 50% of the contract price, and a final payment of 40% for the contract price after construction is completed. The payments are non-refundable unless the entity fails to perform as promised. If the customer terminates the contract, the entity is entitled only to retain any progress payments received from the customer. The entity has no further rights to compensation from the customer. So this is the whole situation. I will repeat, and my question to be popped up is that okay, I will repeat the situation. Listen this situation carefully. My question will be, should the revenue be recognized over time or at a point in time? The question is, okay, I repeat the illustration. An entity enters into a contract with a customer to build an item of equipment. The payment schedule in the contract specifies that the customer must make an advance payment at contract inception of 10% of the contract price right to payment for performance completed today in accordance with IFRS 5 if the customer were to terminate the contract? Okay. My question is, should the entity treat this contract uh, over the time, or should the entity treat this contract option 1 over the time, number 2 at a point in time. Okay, before going for pop-up, I will just quickly re-narrate the facts. A company entered into a contract to build an equipment. 10% was the advance. 50% will be paid over the period of construction, and the remaining 40% will be paid after construction is completed. And the payments are non-refundable. The entity is entitled only to retain any progress payment received from the customer. The entity is entitled only to retain any progress payment received from the customer. Means you might have completed 80%, but by that time, entity would have received only up to 60%. So this is the question, and assume that there is no alternative use. Okay, pop up the question, please.
Brown was asking which question I'm talking about.
As I mentioned, as I told you, it is not written anywhere. I just gave you the situation, very simple situation. You entered into an entity entered into a contract to build an equipment, 10% advance, 50% will be paid over the period of the construction, and once construction is completed, the remaining 40% will be paid. There is no alternative use of this asset, and so now this is this pop-up question.
Yes, I think that's about 1 minute and 30 seconds. I think that's the order. Sharing the answers.
Yes, please.
59% said over the time, 41% said at a point in time.
59% said
Over the time.
over the time. Over the time, and
41% said
at a point in time. At a point in time. This is the reason why the board feels that this is a difficult standard, and they are continuously issuing guidelines on this standard. Anyway, I'll be explaining this situation. See, in order it to be recognized over time, in this particular situation, two conditions must be met. One, no alternative use, no alternative use of this asset, and customer is entitled, this one, there is an enforceable right to payment for performance completed to date. Enforceable right of payment completed to date. In this very small illustration, I clearly mentioned asset has no alternative use. So this means this criteria was met. This criterion was met. Now, we were only required to evaluate whether this criterion was being met or not. See, I gave you the payment term that 10% advance and 50% over the construction period. And if they do not complete, or if there is any problem, so then customer will not get anything except the amount he has already received under these terms, and 40% will be paid after the completion of this equipment. So this means over the construction period, you might have completed 70%. But because of the terms of the agreement, you are only able to retain already received 60%, or maybe a lower percentage than 60%. So this means the second criterion, legally enforceable right of payment completed to date, will not be met. So as a result, this will be recognized at a point in time. So this is very important, especially those people who are involved in the construction industry. this concept is very important for them. For example, if they are building if they are constructing a building, so they need to analyze, evaluate their contracts very carefully so that they could see that if these two criteria are being met, only then they can recognize revenue related to that building over the period of time. Otherwise, at a point in time. So maybe it is because this illustration was not in the written form in front of you, but anyway, I hope now this point should be clear. Okay, I'll give you another example. Another example is
Deepak is asking is if the point in time is end of the contract.
Yes, point of time is end of the contract. So this is a big change as compared to the previous approach, especially for the construction contracts. Okay. This was the joint project of IASB and the FASB. IFRS 15 contains guidance for transactions not previously addressed, service revenue, contract modifications. IFRS 15 improves guidance for multiple element arrangements. IFRS 15 requires enhanced disclosure about revenue. Impact of IFRS 15. Impact of IFRS 15. Number one is, for straightforward retail transactions, IFRS 15 will have little, if any, effect on the amount and timing of revenue recognition. So this is a good news for those people who are in the retail industry. For contracts such as long-term service contracts and multi-element arrangements, it could result in changes either to the amount or to the timing of the revenue recognized. IFRS 15 must be applied retrospectively, that is, as if it has always been in place. Though you will be applying this IFRS in 2018, but you will have to incorporate its effect in 2017 figures as well. So it is better you should well prepare yourself for this standard. This will be a labor intensive for companies with a lot of long-term contracts, particularly in the construction industry. Tax planning issues where different amount of revenue will now be recognized in different periods, though total may be same. Can they see us? But they cannot listen us. Okay. Impact of IFRS 15. IFRS 15 must be applied retrospectively, that is, as if it has always been in place. Companies will therefore need to re-perform any calculations performed under ISA 18 and adjust opening balances. This will be labor intensive for companies with a lot of long-term contracts, particularly in the construction industry. Tax planning issues where different amount of revenue will now be recognized in different periods, though total may be same. For example, for telecommunication companies, most impacted industries are telecom, where they are offering like a package which includes free headsets and the mobile services. So this standard will have a drastic effect for these companies. Software developers, software developing companies, real estate, and other industries with long-term contracts. So these will be the most impacted organizations. So one of our respected member asked a question about the warranties. See, please, for warranties, note, if a customer has the option to purchase a warranty separately from the product to which it relates, it constitutes a distinct service and is accounted for as a separate performance obligation. This would apply to a warranty which provides the customer with a service in addition to the assurance that the product complies with agreed upon specifications. But if the customer does not have the option to purchase the warranty separately, for instance, if the warranty is required by law, that does not give rise to a performance obligation, and the warranty is accounted for in accordance with IAS 37. So if we have any question, we can answer that. My email address is mentioned in the footer. Another email address is let me open the pen. Another email address is abubakar@bakertilly miq.com. Okay. Do we have any question?
Yes, Deepak is saying, so don't you think that with the new standard, just by changing the contract terms, the revenue can be shifted? People can take benefit of this?
This aspect need to be evaluated, Deepak. I mean, who will get benefit out of this situation? This can affect your tax revenues, but in fact, to greater extent, this will be a timing difference in certain cases, and in other cases, this can have drastic effect on the reporting of expected results. So this can affect the share prices of the company. This can affect the perception of the shareholders about these particular companies, where they will be seeing drastic changes, unexpected changes in the revenue over a couple of years to come, especially in 2008. You are very right.
But Anuddin IFRS says that please go into little detail with on the subject of warranties on certain products. For example, you construct a portable building with 5 years warranty. How it will be treated in IFRS 15?
See, if that warranty can be separately bought from you people, if it can be separately bought, then this is a separate performance obligation. Like if someone does not buy Porta cabin from you, but he can enter into a warranty agreement for the services of that Porta cabin, then this will be a separate performance obligation. So this will fall under IFRS 15.
Okay. Sayyid Salam Bilani is asking, would there be a session on consolidation?
See, if most of members will request, a lot of members are listening to me, so we can arrange a comprehensive session on consolidation, starting right from very basic and going to even International Accounting Standard 21 and even difficult entries related to the consolidated financial statements.
Okay, Mr. Burhanuddin is saying thank you very much. You've completed my conclusion.
Thank you, madam.
Zishan is saying thank you and enjoy the rain. It's raining in Karachi today.
Okay, good.
Sayyid Aslan Gilani had asked the same question about consolidation. Rina is saying please confirm the email address abubakar@banker.tv.
Yes, Rina.
MIQ, it's MIQ.
Yes, sorry.
It's MIQ, it's not MIAG.
Yes, MIQ, BAKERTILLYMIQ.com. And we can provide you the implementation services as well. Like if any company wants to wants help from us in the implementation in their particular situation, we can, and in the restatement of the figures in 2007, and we'll be happy to provide those services.
And 70 to 80% of the members pay in advance, but the rest pay in partial, like 50 to 60% advance. Company books receive fee as unearned income and debit for cash and account receivable. Company amortize the unearned over the period, but doesn't adjust the receivables which do not pay the and leave the debt and institution, and doesn't come back and never use the period of membership time. Isn't its revenue overstated then?
Is Mr. Zishan?
Not that percent.
Nadir, I tried to appreciate your scenario, but what I understood, I can tell you the correct treatment. Then you can appreciate yourself whether they are doing right or not. Even after that, you are not satisfied. My email addresses are in front of you. You can send me the whole situation. I can comment on that situation accordingly. But anyway, if you receive fee advance from the student, so debit account receivable will not be debited. Of course, cash or bank will be debited and credited to the unearned income or deferred income. And as the time passes, as you deliver the services, so you will be debiting the deferred income and crediting the revenue. Account receivable will only be involved if you have already delivered the service and the student has not paid the amount. So account receivable will not be involved in your situation, especially for those students who paid in advance. So, do we have any question? Thank you very much.
Can we ask them to send us their feedback through the questions dialog box this time? We don't have a pop-up question for them this time. So, on a scale of 1 to 3, 1 being excellent and 3 being below average, where do you think would you rate this webinar? So, please type your answers in the questions dialog box. If you write 1, it would mean it was excellent, 2 would mean it was good, and 3 would mean it was below average. Thank you. This is mostly ones.
Thank you very much. Thank you very much, respected members. So this encourages us to do more for you, and you are welcome. If you have any question, please send me emails, so I'll be happy to answer your emails. Thank you very much. So now we can close this session.
Yes.
So we will inshallah meet on next Friday at 3 p.m. With financial instruments. So this ends the session related to IFRS 15. Thank you again.